Hello, everybody. Welcome to the Enlightened Investor, your home for economics and financial updates. And man, do we have a financial update for you? Good Lord. When the President of the United States, the Secretary of Treasury, the Federal Reserve President, and the FDIC President get together over the weekend, you know something's going on. And are we going through another bank run? What about this bailout we're going to have? Is this another global financial crisis part two? And that's kind of what we're going to talk about today is this really, we've been talking about uncertain times now for over a year and a half. And this last 48 hours, 72 hours has shooken some confidence in our system. And so I hope you guys are doing okay out there. We're without our main man, Mike Mahoney. He's on special assignment today. But we're here from Peoria Heights getting ready to give a little show on what happened to our economy. Is our financial institution at risk again? What did the government do over the weekend? And what does this mean? Probably means we're likely going to have that recession the second half of this year, as we talked about. And don't forget, folks, that depositors did nothing wrong on this. This is a whole, we're going to get to the nuts and bolts of what happened here today. So buckle up. Here we go. So first off is Warren Buffett has a quote. He said, "Risk comes from not knowing what you are doing." And I think in this particular case, some of these bankers like at Signature Bank of New York or the Silicon Valley Bank out there in California, and even like Silvergate Capital, they were exposed to these long duration bonds when they knew that interest rates were going to go up, and obviously those are going to take a hit. Those bonds are going to take a hit, which means your balance sheet takes a hit and your capitalization takes a hit. So risk comes from not knowing what you're doing. And these banks were tier one banks. They went through stress test, folks. And it really is shaking people a little bit up at the core. So what happened? Let's take a look at this slide here. This is our second and third largest bank failure in the United States history, just over the last couple of days. Washington Mutual, if you can remember that, back in 2008, that was the largest bank failure, about $300 billion. That was eventually gobbled up by J.P. Morgan Chase. And what's going on right now is that the Fed is working, who is backstopping all this, they're working on trying to get a buyer for Silicon Valley Bank, which is rated about $210 billion in assets, and Signature Bank, which is about $115. So right now, the Fed is backstopping up the liquidity for the depositors, for the companies that are banking there. But I want to let you in on a secret, which you can look up online anytime right now. The Federal Deposit Insurance, FDIC, how much do they actually have in their reserves in case of an emergency? Do they have trillion or 500 billion? No, the answer is 125 billion. And not enough. And folks, look at that graph there. The Silicon Valley there, that's 215 billion. That you're already over the top. So we'll talk about fees here in just a moment. Like what's going to happen moving forward? We'll take a look. So why is this financial system at risk again? I mean, did we just get over this thing a few years ago in 2007, 8, and 9? Well, again, the bank's balance sheets were exposed to interest rate risks. And as interest rates rise, the price of bonds fall. And for example, Silicon Valley Bank had $91 billion of bonds on hand, which isn't bad. They were in treasuries. They weren't like in risky, mortgage-backed securities that were like, all mangled up with that whole housing situation. No, they just sold about 21 billion and took a $2 billion loss. And then the word got out like, hey, do you know that bank you were at? They just took a $2 billion loss. You better get your money out of there. And you get a bank run. And those things, one of the things I want to leave you with today is that risk happens fast. Risk happens fast. So just remember that as you go forward here. Diversification is key. So here's another slide I want to share with you is that take a look at the impact of the interest rate rise. This is the 2-year treasury yield moving up from about 1.5% all the way up to about 5%. So that's about a 4.5% gain there. And then what happens to the valuation of overall S&P Bank ETF? You can see how that is negatively correlated. And the reason for that is that capitalization, the net owner's value, goes down with these losses on paper. So this was really just about a paper loss. People weren't out in the street waiting in line to take money out of their bank. It was all done very quickly electronically, like an electronic bank run instead of like although you did see people waiting in line as well. So what I have here for you, and this will be kind of fun, especially for all you folks out there who are accountants. I just put together a very simple example. You should be able to follow this very quickly and easily on the example of interest rate risk. Let's name a bank here called Regional Bank USA, and regional banks are in trouble today. A lot of them are down quite substantially. But let's just say they have a typical balance sheet where their assets on the left-hand side are cash of 100, loans of 400, and then bonds of 500. And then over on the right-hand side, they have demand deposits of 950 and net worth of 50. And you can see that both the left-hand side and the right-hand side equal $1,000, right? So what happens when you have a 5% increase in a 2-year bond, 4% increase in bonds? Well, that might lead to a 10% decrease in the value of that asset holding, the bond holding. So the assets go from 500, and then we'll go to this next slide. You can see it goes to, in blue, 450. So there was a $50 billion loss or $50 loss on paper in this case. Nothing else happened. The demand deposits didn't change. The loans still kept coming in. The amount of cash didn't change. The only thing that changed was the bonds. So look over at the right-hand side now, underneath net worth. Take a look at what happens when the bonds go down. They have to one for one go down as well. So as bonds fall in value by $50, net worth falls by $50, and the bank becomes insolvent. And that's what happened. So last night, Ryan and I were talking about this offline before our video today. There was a statement where the President of the United States, Biden, Secretary of Treasury Yellen, FDIC President, and Federal Reserve President Jerome Powell got together, and they came up with a plan that would protect the depositors and essentially provide liquidity starting today. This is Monday, the 13th, 2023, to the financial system, to the banks. And the Federal Reserve also said that it would make additional funding eligible to any depository institution to help assure that banks have the ability to meet all of their needs of their depositors. So in these statements, I took 4 quotes here. I pulled this off. There's a link there to the treasury.gov. But if you can see there's 3 of the 4 paragraphs. It says that this bailout will not be borne by the taxpayers. It says it 3 times. So the fact of the matter is that I put in there the depositors, there's going to be increased fees at your banks to pay for this. And really, in the end, who backs up the Federal Reserve's balance sheet? You and I do as taxpayers. So anyways, it's not necessarily a traditional bailout where no one got in trouble. There has been some firing. No one's in jail or anything like that. But the fact of the matter, when they say, no losses will be borne by the taxpayers, someone's going to pay, right? And it's going to be either depositors and or taxpayers. Okay, just a few more things. So that's what went on. A few more things is that this concept of moral hazard. Moral hazard is an unintended consequence, which I see kind of coming out of this bank bailout, and that is where you're protected from your consequences of your actions. And here's Wall Street Silver. I pulled this from Twitter yesterday. If all bank deposits are now insured 100% by the government, what new moral hazards are we building into the system? So, as an economist, what we worry about is not only just the bubble bursting, but what I'm more concerned about is why the bubble is growing. And Ryan and I were talking about what zero interest rates did to our risk-taking behavior and how even bank managers maybe went a little bit too long in their holding of bonds. So anyway, watch out for moral hazard, these unintended consequences of protecting people from their risks that they take. 2 more slides and we're done. Just want to tell you that the likelihood of recession has been rising. We saw a big shift in the federal funds expectations just in one day. We were expecting federal funds in July, June to maybe reach a top of about 5.5%. Looks like that's been pulled back to maybe 5 to 5.25. So the Federal Reserve might be pivoting more quickly. And then the last thing I want to share with you is, these are some tough times. It's I met with some older ladies and gentlemen yesterday at my church, and they're like, what should I do, Joshua? And I'm like, oh, it's good to be diversified, have a little bit of cash on hand in case things go sour, and because there is risk of putting money in banks, and the fractional reserve system is very small, and we saw that the federal government just kind of worked on bailing us out. But in the end, I want to share with you this last slide. The markets find a way, and that is the world's a messed up place, right? And we've gone through lots of ups and downs. Like going from 1940, we had World War II, and in the 70s and 80s, we had inflation in Vietnam and commodity prices. We had in the 1980s, we had a flash crash, Asian contagion in the 90s. The tech bubble burst in 2000. 2001, we had 9/11. 2008 to 2009, we had the global financial crisis. 2020s, right? We had the C-19 and high inflation. And you know what happened during all those turbulent times from 1940 to 2022? The S&P 500 was up 10.9% up. So it's, the U.S. economy is still going to be there. It's not a perfect environment. We have these times of fluctuations, but the market finds a way. And it's, there's no choice but to take risks as well and be involved, have some exposure to the markets. Anyway, I hope that helps clear things up a little bit on where we are, where we're going. I think things, we're not out of the woods yet. There'll more than likely be a few other regional banks have to be bailed out here with their balance sheet like we just showed. But, the world's not ending. We're going to be okay. Just might be a little bumpy times in the near future. So this is the Enlightened Investor. Signing off. Take care.